Okay, hello everybody, and welcome to Investing with IBD for December 4th, 2019. I'm your host, Arusha Pierce, and with me today is Mark Ritchie II. He is the Managing Partner and Chief Investment Officer of RTM Capital Advisors. Thanks for being here, Mark.
Thanks for having me.
On today's podcast, we are going to talk about the current market, the importance of tracking your trades, and then we will end the episode with 3 current stocks. So let's get into the current market. We are currently in a confirmed uptrend. We have 5 distribution days on both the S&P 500 and the NASDAQ, but indices, they continue to be near new highs, even though they got hit for a couple of days. Leading stocks, they found some support at key support areas. Mark, what are your thoughts?
Yes, interesting time to be on. So I would say, we talked about this yesterday, Rusha. It was kind of funny in prep. And It was about, 11 a.m. or something. And I said, this is kind of a key spot here.
Right.
We need to find some footing. And sure enough, the bulls kind of came right in on schedule. But, for our clients, we've been as long as we've been probably in the last 18 months.
Well.
So, for those who aren't aware, at RTM, we really just gauge the overall risk as, looking at all the different stocks, different groups, and then trying to gauge market health that way. And we've been pretty cautious. Generally speaking, we're sort of underinvested really all year until the last couple of weeks. We were market weight and we're overweight now, and we haven't sold anything yet in terms of pulling back on the exposure. The main reason is because of the action. The smaller caps look like they're finally making a turn. And, if you want, we can look at a couple different examples of what I'm looking at. We can bring up a chart of the Russell. And then I think sentiment is still, at least according to our work, favoring the long side. I think there's an awful lot of skepticism, pessimism. We can talk, if you want, in terms of some of the specifics that are leading me to say that, because I know sentiment can mean a lot of different things to a lot of different people.
Yeah, so let's first start off with the small cap. So you're looking at the Russell 2000 to get a gauge on how the small caps are doing. And that recently actually finally broke over 1,600, right? So, which is kind of we've been waiting for that for a while. It's come close a few times, but then it would just kind of go back to the bottom part of its range. But finally it broke through last week. And, of course, it came and tested that 1,600 level, but so far so good.
Yeah, I think if you look at the chart, a couple of things to point out. The first would be we've really been in a pretty decent bear market since 18. And while some of the other indexes have, looked like, wow, we made new all-time highs, even they haven't really gone anywhere. But the Russell has remained pretty well below all-time highs, and it lost almost 30% of its value, peak to trough there in late 18. That's a pretty big cyclical bear market from where I sit. And then if you look at some of the individual groups, they've gotten hit pretty badly. And a lot of the traders and people I talk to, or if you speaking with people like yourself, Arusha, going like, how's it been trading growth stocks? It hasn't been easy.
Not at all.
For certain.
Yeah.
And I think it's because a lot of, more tactical growth type managers, they don't necessarily equally correlate with the Russell. But if the Russell is really continuing to, as you said, to look like it's going to break out and then roll over, and look like it's going to break out and roll over, that's kind of what you're going to see. You're going to get a little more aggressively long and then have to pull back. And generally speaking, we've sort of been underweight for that reason sort of all year. We made sort of what looks like a technical or tactical turn last Monday. And, as I said, we're overweight right now, but there's a couple things I'm watching, but, I'm watching the tea leaves really closely. So speaking of the last couple days, if you look under the surface, a lot of the growth stocks that have sort of led us in the last 4, 5, 6 weeks have held up pretty well.
Yep.
And, we keep a secondary watch list of just anything that looks healthy to us, that's leading the advance in specific areas. So it would sort of avoid, your blue chip type names or your cyclicals. And all those groups, I mean, normally, so one of the things I use is I go through that list, and if everything is just getting hammered, usually my portfolio isn't doing very well either.
Right.
But it sort of just gives me a good measure of, well, what is the stuff that's, sort of been leading, holding up, or maybe putting in consolidations? How's it acting? I think I only kicked off a few names in the last couple days. And given that we fell, some 70, 80 handles in an index like the S&P, often you would expect that some of the small caps, really got hit. And, you can see the Russell declined the least and held up the best. Well, that's a pretty good sign. That can change quickly.
Right.
And so that's kind of what I'm watching. The other point I would make in terms of, just sort of sentiment, we're speaking sort of broadly. It's been very hard to gauge looking at some of these classic sentiment indicators of what people are doing. So,
such as the most classic one, the put call ratio, right?
well,
I'm
put call
guessing.
we can talk about,
Yeah.
but that one I think is actually one I think is a little more accurate because it says what are people doing versus what are they saying. And this is something you always want to pay attention to when these surveys say like newsletter writers. Well, newsletter writers, of course, are going to say they're bullish when the markets are making new highs, generally speaking, because they don't want to look silly. But it doesn't mean that they actually bought anything.
Right.
And it doesn't necessarily correlate to what their actual positioning is. And that's what I'm trying to always figure out when I'm looking at sentiment. So it's more important for us to gauge where do we really think the wall of worry level is. Are people really skeptical, nervous, not believing the rally?
Yeah.
From a contrarian standpoint, would tend to make us more constructive. And, a good example would be today, if you click on CNBC right now, they're calling this a blow off top. Well, that doesn't seem like there's a lot of confidence. And I'm not saying they're wrong, but I'm saying, generally speaking, if you're reading on something like CNBC, the market just put in a blow off top, I want to take the other side, especially when I see a lot of stocks that are holding up okay. And we just came out of an 18-month consolidation.
Right. And you also don't see a lot of enthusiasm. There aren't a lot of people like so excited that how well the stocks are doing and things like that. It's more the wall of worry.
It doesn't seem that way. And there's an awful lot of people, as soon as, our president says anything about China, wham.
Right. Right.
Down goes the market. And I'm not saying you have to watch the tape very closely here. And this is where I would encourage anybody in sort of this swing trading, whether it's growth stocks or any of these type of groups that have been trading this move, or maybe you're even just looking to get involved now. Maybe you didn't believe the move. I think you're okay to nibble here, but you got to watch the tape closely. You got to listen to your stops. I mean, we saw this briefly in May as well, where it looked like the Russell was going to kind of make a turn and lead a little bit, and then it kind of cracked really hard.
Right.
So that can happen. But to your point, I kind of try and keep a finger on the pulse of a few different things, and we just haven't seen a whole lot of people pounding the table bullish seasonally. We can look at a couple of examples of things I'm kind of looking at even within the charts of sort of some past precedents, if you will, in terms of the charts. But the one point you mentioned, put call, I would make is that I see that as something that's a contrarian or sentiment indicator that at least reveals what people are actually doing versus what they're saying. If you're buying puts, you're nervous.
Yep.
And you're risking money based on that nervousness. And we saw, it was about 2 weeks ago. You can look this up. On the index, total index put call volume, we had a 2 or 3 year record high spike after like a 1.5% pullback. That tells me you just don't see that very often. Normally, you see that at capitulatory,
right,
puking out the lows type, fear.
Yeah.
2% off the highs. I mean, so I would think that pullbacks here should be very shallow. And so far, I'm not saying the lows are necessarily in from 2 days ago, but So what I would look at specifically is one, obviously, if those lows hold, that's a great sign. But if the market's undercut, say, yesterday's lows, but stocks, the leading groups don't even come close, I think we're in really good shape. And the best case scenario for me, and if you want, we can look at a couple of charts. Even if you go back to say like the S&P in the same period of time in late 13, this is just looking at the indexes to kind of give you, an idea of kind of how I look at things. I'm always kind of reviewing things in my mind to say, how has this happened before? Or how might this rhyme with periods in the past where we had pullbacks, but the market, was actually masking a lot of strength versus weakness.
Yep.
Right now, I think the indexes are kind of, they're taking a breather, and that's fine. But in late 13, we had a very similar period where indexes right around this time of year pulled in after we'd had a 4 or 5 week run. And the market just marked some time for a week or two and then powered to new highs into the end of the year. Same thing happened in 2010. So those are two precedents I think you could look at. And in both cases, I can remember the markets kind of being in this consolidation, and there were just stock after stock after stock that looked really good. Where I remember thinking, I just don't think there's any way we're going to roll hard here because there's just too many stocks that look so good. So I think that's really the big key. I'm not there in terms of, wow, am I just growing horns bullish?
Yeah.
But I could see myself there even in a couple of days. If the index is put in a couple of tight days here, volume dried up, and I think even as the market started to move back toward the highs, you'd start to see the bears go, oh, the volume's not there. This isn't a real rally, and that would tell me I think we're probably going to rally into the end of the year.
Perfect. So the indices continue to hold near new highs, and stocks, they found support at key support areas, and they continue to act constructive. Let's take a quick break, but when we return, we are going to talk about the importance of tracking your trades. Stay tuned.
Pick winning stocks with MarketSmith. Growth 250 shows you ideas with big potential. View charts packed with key data. Use pattern recognition to see action zones. MarketSmith by Investors Business Daily. Try 3 weeks for $19.95.
Mark Ritchie is our guest on investing with IBD. Okay, Mark, let's talk about the importance of tracking your trade. But before that, we spent a lot of time on the market, which was excellent. Let's just spend a couple of minutes on how you got into investing. You have a very, very famous father who was featured in Market Wizards. But yeah, why don't you briefly talk about how you got into this whole thing?
Yeah, I'll be brief on that, I guess. So really, I had no interest in markets, generally speaking, growing up. It wasn't that I just didn't understand it. I had no idea. It wasn't something that was actually talked about at home or anything like that. So people I get the question sometimes, what was the secret sauce your dad gave you or whatever? I don't want to say it was nothing, but in terms of actual trading, I never traded on a floor. And my dad was pretty much wasn't really retired by the time I kind of got interested.
Okay.
I did go to work for an old associated of his, sort of after college, really a time or two, kind of briefly. And, the short story was I kind of headed in what I thought was a completely different direction. I have a philosophy degree, which does not have anything to do with markets per se, although I think there's a lot to be maybe said about logic and discipline and those types of things. But
sure.
I really was just looking for a job. So I went to work for somebody who had been a sort of off the floor trader for my dad. And that whole endeavor really ended spectacularly badly without getting into the gory details. But during that time, I kind of got the bug, I guess, and just kind of watching the markets a bit. And I had a little bit of freedom to put on a few trades here and there, that type of thing. And realizing that I didn't know anything about this stuff, but was really just intrigued by the idea of why are people buying and selling, and why do certain markets trend and others don't, and all of that kind of stuff. Can you develop a strategy or repeatable process, that is consistently profitable? All those kinds of things. And so just started reading and doing all that kind of stuff. And through, I guess, luck or divine guidance, depending how you look at it, wound up on my own in 2010. So, and it was just sort of a process of trying to figure out what works and doing more of that. And that kind of, to the point we were discussing about tracking your trades and figuring out what works is sort of what led me to what I'm currently doing.
Yeah.
Because I'm just a big believer in stats and numbers and those types of things, which is not sexy, but really important.
Yeah. So yeah, this is a big part of the process, and it helped you continue on the right direction for you. So let's go into that importance, because it's a very easy part of investing to overlook, because it isn't sexy, and it's really ugly in many ways, and it's not fun to do.
Yeah, I don't know about the fun. I wouldn't necessarily say that it's not fun, but
well, for most people.
Sure. No, I know exactly.
Maybe for you.
No, I know what you mean by that. So, to pick up even from my own story. So when I started out, I had a couple ideas. And this is what I would encourage anybody on any level that's interested in speculation, whether it's long-term investing, short-term trading. It doesn't matter. You have to have some type of a process or some rules or definitions to something. Otherwise, you're really just gambling.
Mm-hmm.
But so, in the example I had given, I had a couple ideas. They were all really systematic. I shouldn't say really. They were, I was sort of almost like a just quant. I'll just do this. But I kind of had a couple of different little strategies or buckets. Well, I quickly realized as I was just watching the markets and putting on a few of these trades, that I had some of my own, for lack of a better word, discretionary views on the stock market itself. And so one of the good pieces of advice my dad did give me, he wasn't trading with me or anything, but I was just talking to him about this and saying, well, I think the market's going higher right here. And I don't have any system or model that is buying anything. I want to buy this. And he said, well, just, allocate a little bit of your chips, if you will, or capital,
mm-hmm.
and trade those, do some, what he would call seat of the pants trading. That's sort of an old floor guy phrase for discretionary trading. Just do some discretionary trading. So I started buying breakouts, using technicals and, grabbing magazines like IBD or finding stuff on StockTwits or different places and setting stops that made sense to me.
Yeah.
But I was tracking all the numbers within that trading. Well, and it was working. So, you'd be crazy not to keep doing something that's working, right?
Right.
And before long, that was a mainstay in really one of the biggest strategies in the portfolio because I was doing so well doing it. Now, I had a lot of things to learn, of course, and reading lots of different books. And I had read, William O'Neill and David Ryan and Market Wizards and different things like that. So I had read some IBD. So I had some ideas, but the reason I'm still trading, in sort of the swing style or growth type stocks is because over time I have a statistical edge in doing so. So
Mark, what are some of the stats that everyone should be tracking to get better and get an idea of what works for them?
Exactly. Yeah. Great question. So I always encourage people, first of all, when it comes to tracking, you can't cherry pick.
Yes. So
you have to track everything. And I'll give you an example. So every single trade I make in the portfolio has a bucket that it goes in, meaning it has, for lack of a better word, its own Excel sheet where its win-loss ratio, average win, and average loss is calculated. So right there, you need to know what your call it your batting average or your win percentage, however you want to think about it. Wins divided by total trades.
Yep.
You know what I mean?
Yeah.
If you won 5 of your last 10, you're 50% right now. That kind of stuff.
Right.
You need to track that, and then you need to track your average win, average loss. I would encourage people to do the average win, average loss not in dollars.
Okay.
And there's a couple of reasons for that, which we can get into if you want to.
Definitely, yeah.
So the reason I say don't use dollars, one is because dollars have much more of an emotional pull on people, especially as your account grows, which we all hope that it will.
Yes.
Meaning that if you say, I lost 1%, that doesn't have nearly as much emotional impact as I lost, pick the dollar amount, Arusha, and it can vary widely between people. It can be $1,000 can drive somebody crazy. It can be $1 million for somebody else, whatever. So generally speaking, when you track trades, and if we're talking about stocks, I would do it in one of two ways. I would either track the actual gain in terms of percentage basis of that stock. So if you made 10% on the stock, you put it down as a 10% gain.
Okay.
And then average, all your gains. You got a 10, you got a 5, you got a 20, and you average those three out. Even better, though, is basis points. What I mean by that is total percent gain or loss to your account. And the reason I say that is because that will equalize out all of your position sizing. And if you don't think that you'll trade potentially differently with bigger or smaller size, I think you're naive.
Right.
Because one of the biggest mistakes, even professionals, even myself, I make this regularly, go, you know what? I had too much on and I didn't trade that the way I should have. Or I didn't have enough on and I let that thing dig into my pocket. Maybe, I gave it too much room in terms of a stop because it was a smaller position. These things are really, really important. But if you think in terms of basis points, so the way I would do it is a 1% trade. The other reason I like basis points sometimes is because you can round down to the 10th of a percent, So I made 81 basis points. That's 8.81% to your total account on any given trade. And I could tell you, where where any little bucket of strategies is within our portfolio. And then what you can do is you can take these data sets and study them for patterns within your own trading. And this is it's almost like a second level advantage that you'll have if you track this stuff, where a lot of people, they don't want to do it because it does seem a little burdensome. And by the way, that's what most hard work is. What was it, Edison or something said, like, most opportunity looks like hard work in overalls or something like that. This is part of the work you got to be willing to put in, especially when you're starting out, though, because you're not going to have the confidence to know what really works, and studying this stuff will help you. This is something I still review to go, do I have an edge here over any given sample? Maybe, there's a whole lot of questions this raises about, the validity of certain sample sizes and such. But a good example that I had mentioned to you before, Arusha, was, my very first year, I was doing some short-term trading. I did a whole year's worth of trading.
Yeah.
And made no money, almost to the penny. It was like I'd done hundreds of trades in this certain strategy, short-term trading, and broke even. Most people would say, what a waste of time. Right. And it felt that way, certainly. But then I studied all the trades, and I'd taken some notes on them. And this is one other thing I would do. So when you start out, obviously track your wins, losses, average win, average loss. And then if you can, take some notes. Why did you get in the trade? If you have a specific setup that you maybe it's a technical, maybe it's fundamental, maybe it's a combination, just write a few little notes, because then you can go back through and say you did 200 trades, but you did 40 within this that shared a couple of characteristics. So lo and behold, in this larger group of break-even trades, there was one setup that I just sort of pulled out, and I said, well, if I just taken these trades, where would I be? And the thing looks pretty good. That's a setup I continue to trade today, and it's been profitable. I think 1 year it lost money, but only a little bit, and which was within the realm of statistical probability theory based on the previous so many years. So it's been profitable, I think, 8 out of 9 years.
Wow. And you have to also try these in a number of cycles too, right? So a number of different uptrends, because every uptrend is a little bit different too. So now you'll get a little bit better data set.
The bigger the data set, always the better. And listen, there's a lot in that discussion in terms of, there's even some art in terms of what's the better way to treat certain size data sets and all that, but none of that matters if you don't track it.
Right. Yeah.
So it's sort of like, even when we talk about risk management, and people are like, oh, well, I use stops. It's like, okay, congrats, you're on first base. It's a little more nuanced, than just trading with stops.
Right.
And tracking your trades is one of those things. Just think of it in terms of, you can even see some of your own weaknesses. Are you choking stuff off too early? Are you letting losses run too much? You'll see pretty quickly even where your personal, for lack of a better word, like defects or weaknesses are. Trading is a fascinating endeavor that tends to expose people's inherent flaws.
Right.
I think Richard Dennis was the one who said speculation is an upstream swim against human nature.
It really is.
Couldn't be a truer statement.
Yeah.
And, drawdowns by their very nature, they tend to be trying on people's emotions more so than their capital. Both. And they can lead you to do, even some really silly, crazy, goofy things that you wouldn't otherwise be doing. But studying this stuff, I'm saying it's a really important tool that's often neglected, or people don't want to do it because it's painful.
Yeah, you're absolutely right, Mark. So tracking your trades is critical to getting better in the markets. Coming up next, Mark and I will talk about 3 stock ideas. We'll be back. Hey, Arusha here with a big announcement. We have launched a brand new interactive video broadcast called IBD Live. IBD Live takes you behind the curtain to see how professionals trade. Log on and watch live as IBD's analysts and portfolio managers follow the first hour of market action and pick winning stocks. You get to listen to our conversations, see our screens, and ask us questions all in real time. If you've ever wanted to trade alongside a team of experts, this is your chance. Go to investors.com/IBD Live and sign up to get your first 2 weeks for free. We are back with Mark Ritchie II on investing with IBD. Okay, Mark, let's get into some current ideas that are on your radar. The first stock is one that we are all familiar with, Amazon, but this is one that's been taking some time off. Why do you like this one right now?
Yeah, a name I'm sure no one has ever heard of to get us going here. Yeah, well, I wanted to share, sort of a couple different ideas of different I guess, sizes and flavors, if you will.
Yeah.
But I think Amazon is really interesting for a couple of reasons, both technically and fundamentally. And first of all, I would say, yes, it's a little bit off of the radar now, especially in the last couple of weeks, because quite frankly, you're somebody who looks at the relative strength line, you go, this ain't for me.
Right.
And I totally get that. I think it's a valid argument. But I think if you look at the weekly, you'll just see this is putting in a pretty decent size, pretty healthy cup and handle consolidation. And it had a huge move. And, even off of, sort of that bear market, you see it handled it pretty well. And then volume is just kind of starting to come in on this right-hand side of the chart. If you're somebody who, watches some of those consolidation or dry up in volume type things. Mm-hmm. And then one of the things I really like that is sort of a nuance within this chart that you can't actually see on the chart, but if you're watching the stock, on the earnings, this was
October 24th.
Yes, on the 20 they announced, yeah, after on the 24th, they actually put in a huge shakeout, which isn't on the chart because the shakeout occurred in the after hours after they announced. So they went as low as I think 1620, 1625, and that was really kind of taking out some key areas from the weekly low in June, the weekly low in late September, early October.
Yeah, that's
Yeah,
interesting.
we would kind of call the handle. You don't see it on the chart, and then it opened at about 1690, 95, and rallied immediately,
Yeah,
which is convincing, and it traded quite a bit of volume. Several million
huge volume,
shares
yep.
swapped hands. Well, to me, that is sort of that classic, the strong hands taking out the weak hands. That's what you want to see is these charts roll from left to right. You want to see, strong hands absorbing all of, those weaker sellers. So I think right now Amazon can be, pretty, even as it pulls in here. If you want to trade against those lows, 1695, 1685, they've already really been washed out. Would be my point. And if we start to, for those who want to be more even conservative, you could wait till it, breaks above 1850, and probably if you want to play this for, I think, a longer term, possibly bigger move. Fundamentally, I really like it as well for a couple of reasons. But one is they just did what Amazon has done so many times in the past, sort of sandbag the expectations. Disappointed, holidays not going to be that good, and writing a few things down. So I think the bad news is already priced in there. But I just don't know anybody who isn't going to spend more money on Amazon now that One Day Prime, which hasn't even gone fully nationwide yet, is rolling out. And, it's very rare that you have a product where you can ask almost anybody that's our age, Arusha.
Yeah.
Just ask them if Amazon doubled their price for Prime tomorrow, would they pay it?
Absolutely.
And everybody I know would say absolutely.
Well, we probably should cut that off the podcast. We don't want Amazon to hear about that, though.
Yeah, well, my point is, it's something that people have just kind of come to depend upon. And Amazon they're the classic, first mover sort of in everything, getting market share. And their addressable market in terms of even some of the, I hate to use the FANG names, they're have much more runway to go.
That's interesting.
Than, say, an Apple, a Facebook, a Netflix. And, in terms of the earnings, I think there's a really good chance. If you look at, where the earnings really came in last time, it looks kind of similar. We have, I think there's a good chance the earnings could go up quite substantially, especially because they've spent all the money to roll this out and haven't pulled in any of the revenue yet.
Yeah.
Taking Same Day Prime as an example, how much more is the average household? It's not that they're going to spend more money in terms of their retail spending. They're just going to spend it at Amazon instead of at Home Depot or Best Buy or Walmart. That's just, again, this is my view. And I also think it's sort of an interesting proxy of the bull market. So this bull market is going to have another leg. I think at some point Amazon's going to join the party again, possibly in a big way. So you have some technicals that are setting up pretty nice in my view. So I think it's certainly worth a look.
Yep, and it's right near. This is what you call trading near the danger point for Amazon. So very, very, very tight stop. If it gets over the 200-day, that gets more technical reasons that it could be waking up here. Let's get into the second stock, and this is Cogent Communication Holdings, ticker symbol CCOI, and this is a mid-cap stock. And what do you like about this stock?
Yeah, I mean, I think the technicals, again, look pretty good.
It's a really nice space, yeah.
Yeah, it's just kind of working through, the right side of a cup here. And to me, there's a couple things I like, but the first one is you sort of saw the biggest volume in the cup, like on a reversal week at the bottom. Mm-hmm. Well, that's supportive action. That's what you want. Again, the strong hands kind of supporting the stock. This one has been, if you look at the weekly, it looks kind of choppy. So I wouldn't necessarily be holding this for a really big move. It would be more of kind of a trade.
Okay.
But even right here, it comes up the right side. It pulls in pretty orderly. Volume's starting to dry up on the right-hand side. I think, in full disclosure, I own all three of the names we're talking about, but these are all ones I would add, not I just own them, buy them. These are names I would be looking for spots to add to. I think, though, even if you look at this little, call it a flag on the weekly, if you waited till new all-time highs to buy and then stop yourself out, say at a couple days ago's low, you're still looking at, mid to high single digits on a stop, which is pretty conservative. If you want to cheat and find, something on a daily or an intraday to get longer earlier, I think it's a decent risk reward. And then the earnings look pretty solid. This isn't a group that I think is, I'm incredibly excited about, where, there's going to be this rapid earnings acceleration. These guys are one of the bigger players in internet service. I think they're going to continue to do well. And I think the chart's kind of showing you that.
Yeah, and they have the whole 5G trend going on. Also, what I also noticed is that their after-tax margins this quarter has really jumped. It was around 6.9% one quarter, 5.3%, 10% this quarter. So they might be getting better at managing their business too.
Yeah, the fundamentals look really strong, and it's as you were saying, clearly these guys are doing some things right here, and a lot of this stuff, even I always you want the charts, in my mind, to sort of make sense. I'm not a classical chartist or one of these people that say, well, this chart's showing this, therefore this is going to happen. To me, these are just representations of supply and demand, and a lot of times it's just noise. I don't believe, this is again my view, but I don't believe that you can just look at any chart and go, this means that and this means that thing. It's like, I don't see it that way.
Yeah.
But there are some things where when a stock, or a chart behaves in a certain way, sort of like with the Amazon example. Well, these lows got shaken out, and then the stock opened and rallied immediately on strong volume. Well, that tells me someone, of size was stepping up there and willing to take, supply at that level.
Right.
Sort of the same thing here. These cups, in some of these charts or different patterns are just produced by, strong and weak hands changing hands. Sometimes, or I would even say rarely, that gives you sort of a tip off. I think it was Jesse Livermore who talked about the line of least resistance, where it can kind of tip you off to maybe where, all things being equal, things are going to go if this continues. Doesn't mean it has to continue.
Yes.
Tomorrow we can wake up, everybody gets nervous for who knows any reason. They will sell, hard and blow up all these charts.
That's very true.
We've all seen that. If you've been doing this long enough, the market can look great, and then for whatever reason, charts, as quickly as they can look pretty, they can look really ugly. I'm only pointing that out to say I just think it's one of these that looks like it's going through that process, and then you look at the story and you go, "Wow, that makes sense."
Let's go to the third stock, and this is Bio Delivery Science, ticker symbol BDSI, and this is a small cap stock, and they have some pretty good earnings going on here, and definitely out of the three, the strongest on a relative strength basis.
Yeah, certainly. This one, again, I own it. I wouldn't buy it here. I want to be clear about that. But I think this is one to watch really as sort of a classic smaller cap, big growth, potential super performer, meaning something that could and should double if things continue. And, it came out of this little consolidation just below $5. Really when the rally kind of started getting going in the overall market late, late September. And I haven't sold any of it because, and I don't own a huge position. I'd like to buy more. And I'm waiting for a consolidation. But if you look, you can see big volume coming in. Up, 5 of 6 weeks on big volume. The only, prior to the last week and a half, only sideways week on lower volume, put an inside week and immediately resumed the uptrend. I think one point it was up 13 to 15 days. That's sort of one of those textbook signs for institutional demand. And then if you look at the number of funds, you see it right there. on MarketSmith, you can see the number of funds are increasing
pretty steadily. Yeah.
Pretty steadily. And that's what's producing this. But it also tells me that when they're coming in, there's probably dip buyers. It doesn't mean there has to be.
Yeah.
But all things being equal, some of those bigger players are going to be buying more of this name if it does pull in, which is what produces sometimes these secondary consolidations or these periods where the stock just marks time instead of pulling in really hard. And then they have some really interesting things on the fundamental side, sort of the story side. Biotech, as always, you need to position yourself accordingly. There's headline risk and different things like that. These guys are really kind of a one-trick pony. You can look into the story a little bit, but they really just have one drug that is kind of producing most of their earnings, and it's an opioid. It's not an opioid alternative, but it's a different kind of opioid that. And for those who follow any of the social implications, there's quite an opiate addiction problem in the country currently, unfortunately. And these guys at least claim that this is a drug that is far less likely to have people struggling with addiction, specifically because of the way it's dosed. So it isn't pills.
Okay.
And it isn't one of those things where the doctor gives you, a script that you can abuse, for lack of a better word. It's dosed over long periods of time, and you can read about it a little bit. But reading their last and listening to their last call, it's pretty clear there's a decent amount of demand, and they meet some of the classic, O'Neill biggest winner type things. It's emerging from a consolidation, showing really good volume, has big earnings and sales, and then this product is in for lack of a better word, potentially high demand. I just don't think you can discount how far that can go. So sort of everything kind of makes sense for this to have a big move, and it has that smaller float, smaller market cap. It's under $1 billion market cap. Those stocks can have big moves.
Right.
If you think of it in terms of law of large numbers, yes, it's only, $6.5, $7, but a stock like that can go to 12 a lot easier than a $10 billion market cap can double. This is sort of the law of large numbers, and it's those funds that are going to push it there. And you can even see in the stock's history, it's had some other runs like that. So I think it's one to really be watching, even in this last couple of days, with the market pulling in. It's pulled in a little bit, but barely even below last week. Went out last week almost, at multi-year highs. It's definitely a strong mover. So one to watch.
Excellent. So there are 3 ideas to consider. Thanks, Mark, for joining us today.
Appreciate it. Thanks for having me.
That's it for this week on Investing with IBD. Next week, we will have JC Peretz on the show. He is the founder of Eagle Bay Capital and also the founder of AllStarCharts.com. I'm Arusha Pierce, and thanks for listening.